Okay, welcome to today's class. This is group account. So today we are actually going to look at another question on group accounts with special emphasis on consolidated statement of profit or loss. So this is the question. It's an icon question also. It reads thus: Adana PLC has a subsidiary, Ebuka Limited. The statement of profits are given below. So we have Adana, we have Ebuka, revenue, cost of sales, gross profit, other income, distribution cost, administrative expenses, other expenses, finance cost, profit before tax, income tax, profit for the year, other comprehensive income, gain on revalue of properties, and total comprehensive income. So these are the additional information. 1. Adana acquired 75% of the share capital of Ebuka 3 years ago. Goodwill on acquisition was 280 million. The recoverable amount of goodwill at the year end was estimated to be 268 million, and this was the first time that the recoverable amount of goodwill had fallen before the amount of initial recognition. During the year, Ebuka Limited invoiced goods worth 300 million to Adana. A quarter of these goods are included in the inventory of Adana at year end. It is a policy of Ebuka to invoice goods at cost plus 25%. The distribution cost of Ebuka include depreciation of an asset which had been subject to a fair value increase of 155 million on acquisition. The asset is being written off on a straight line basis over 10 years. The other income in Adana include 10 million naira received from Ebuka for management services. Now you are required to prepare a consolidated statement of profit or loss as at 31st December 2017. Now this is the first thing we will solve today. Now we'll look at the explanatory note I usually provide, which explains everything easily. The first one is the recoverable value of goodwill is 268 million and is lower than the initial value of 280 million, and this indicates that there is an impairment of goodwill. Now how do we treat it? I provided that you can see it. The difference, which is 12 million, should be deducted from the consolidated cost of sales and goodwill. The seller is Ebuka and the unrealized profit is in its profit for the year. This unrealized profit of 15 million, how was it gotten? The intragroup sales is 300 million and they told us a quarter is still remaining. So multiply it by 1/4. That will give us the value of sales, the value of goods that remain unsold. Now, he invoiced goods at cost plus 25%. So usually the formula is 25/100 plus 25. So that is what gave us this. So when you multiply it to give us 15 million, you can use your calculator to verify this. How do we treat it? I also provided it. This should be deducted from the consolidated cost of sales and from consolidated inventory, the internal group sales. The internal group sales is 300 million and should be deducted from consolidated cost of sales and consolidated sales, that is revenue. The fourth explanatory note: there is an extra depreciation of 15,500,000. 15,500,000. And how was it gotten? It was gotten by saying 155 million divided by 10. And this value should be deducted from consolidated distribution cost and from the consolidated non-current assets. 5, which is the last one. The intergroup management charges should be deducted from consolidated other income and added and deducted also from administrative expenses and deducted from administrative expenses. Adana PLC. Adana PLC now want to consolidate. Now remember the rules guiding consolidation. This rule states that for you to consolidate a company, you must consider certain factors. One, intra-group transactions must be adjusted appropriately, and after adjustment, we must make sure that this is accounted for. Now, how do you consolidate? You add the value of the holding company plus the value of the subsidiary. Then you now less intra-group transactions, if any. So we take the line items one after the other. We have revenue. The revenue of the holding company is 986,547 naira plus the revenue of the subsidiary 640,206 naira. Take away the intra-group sales, we now have this value. I hope that makes sense to you. Now come to cost of sales. Cost of sales, you take the value of the holding company, you take the value of the subsidiary, which are 593,204 plus 365,903 naira. Take away intra-group sales, which is 300 million. Now add back unrealized profits. That is the pattern. You must cram this. Add back unrealized profit as you have calculated, then also less impairment of goodwill of 12 million. That will give you this value appropriately. Now we now take away this from this. We have our gross profit. Haven't gotten your gross profit, we move to other income. Now other income is the other income of the holding company, which is 57,850 plus the other income of the subsidiary, which is 12,420. Now you deduct 10,000 naira. 10,000 is the management fee, intra-group management fee that Adana charged Ebuka. So you don't recognize revenue earned from your family member or group member. So that is why we are deducting this 10,000 naira appropriately. Then if you add all this and deduct this, you now have 60,270. We now look at administrative expenses. You add the administrative of the holding company, which is 158,624, plus the administrative of the subsidiary, which is 95,626, minus the intra-group management fee that Ebuka deducted from administrative. You less it. Added to administrative, so you deduct it. So you now have this value. So the next item is distribution cost. Distribution cost is 69,496, which is a holding company, plus that of the subsidiary, plus your extra depreciation of 15,500 as showed the workings in the explanatory notes. So we now have this value. The next item is finance cost. You bring the finance cost of the holding, finance cost of the subsidiary. The next one is other expenses. You bring the other expenses of the subsidiary and that of the holding. So when you minus, you have profit before tax of this. So income tax expenses, you add the two companies' income taxes, you have this value. So we now move on to profit for the year. Profit for the year will now be profit before tax minus income tax. We have this value. So you now take care of your comprehensive income, which is revaluation surplus. The revaluation surplus of the holding company plus the revaluation surplus of the subsidiary, that will give us this value. So we move on to total comprehensive income, which is this. So with this, we now do profit attributable to the NCI and PC. PC means parent company. You will first of all calculate profit attributable to NCI. You take the profits in their financial statement, which is 72,364. Let me show you. So you'll be very sure of what we are doing. You take the profit, which is 72,364 profit for the year of the subsidiary. When you take it, you start deducting intragroup items. The first intragroup item you will deduct is the unrealized profit, since the subsidiary is the seller. The next one you deduct is the extra depreciation, since it will be deducted from their profit. The next one you now add back is the management expenses, that is an intragroup expenditure that has been deducted. You add it back. So whatsoever after this arithmetics, whatsoever it gives you, multiply it by the percentage of holding of the NCI, and that will give you 12,966. How do you now get parent company zone? You now say the profit for the year in this our computation minus the one attributable to the subsidiary. You can see it. That will now give us the one attributable to PC, which is parent company. That same thing is applicable under total comprehensive income. So that is that for that on this. Now there is a B section in this year question. The B section says a parent company acquired 600 equity shares of its subsidiary 3 years ago for 1,200,000 naira. The subsidiaries issued equity share capital on that date was 250,000 naira, denominated at 25 kobo per share. Other components of the subsidiary net assets at acquisition date were share premium of 550 and retained earnings of 680. The subsidiary shares were quoted at the stock exchange at 1 naira 80 kobo per share. At that date, the parent took control. You are required to prepare Goodwill on that date format. Now you come down. Before you need to first of all calculate. You need first of all calculate the number of shares acquired. They said there are how many shares in the companies? 250 shares, and the nominal value of the share is 25 kobo. So how do we now get the number of shares acquired by the holding company? So we now come here, you open bracket, so you now have 250,000 shares divided by 0.25. You understand? Good. That will give us about 1 million shares. That will give us 1 million shares. So, and they told us in that question that the holding company acquired 600 shares. So out of 1 million shares, 600 shares will give minus 1 million shares will give us 400. So that is how we got 400,000. I hope you are there. Now, to portray my points very well, you can see that this will now give us 1 million shares. And this 1 million shares, and the holding company bought 600. So how many is remaining? 400. So 400 belongs to NCI. So to get the value of NCI at date of acquisition, they told us that the market value of shares market value per share is 1 naira 80 kobo. So multiply this, you have 720. So when you add these two, it will give us this consideration. So you now come and calculate your net assets. So share capital is 250,000 shares. 250,000 naira. Share premium is 550. Retained earnings is 268. So when you add this, you have this. So take the net assets away from the consideration. You have a goodwill 440,000 naira. That is just what you are expected to do, and you've gotten your 4 marks as the case may be. Now the next item, which is a C part in this diet, was an open question that said IFRS 10 states that with certain exemptions, a parent must present consolidated financial statement in which it consolidates its investment in subsidiary. Requires state 4 exemptions to this rule. I didn't provide a written solution, but I will tell you orally. The first exemption is a company shall not consolidate where it is a subsidiary of another company. That is number 1. Number 2, a company shall not consolidate where its shares or debentures are not quoted on the stock of Nigerian Stock Exchange, on the floor of Nigerian Stock Exchange. These are the 2 core exemptions. Also, a company shall not consolidate where its parent company is a subsidiary of another parent company and their shares not listed on the floor of stock exchange. So these are the exemptions upon which a company shall not consolidate its financial statement, irrespective of the fact that it is a group company. So that is that for today's class. I hope that makes sense to you, and I hope you appreciate the class. In our next class on group, we'll take another question to buttress our points. Please do well to ask questions if you are confused, and we'll provide answers to your questions. Thank you for the night, and thanks for attending. Do have a nice